Remember, we've got an expiring coupon code for the courses on building your wealth. Link down below. Check them out before the price goes up. I hate to say it, but the real estate bubble that the Federal Reserve warned about right here, folks, is beginning to burst. Take a look at this report from the end of March from the Federal Reserve, the Dallas Federal Reserve Research Division. Quote, "We argue that the underlying causes of the run-up differ from those of the last housing boom, which preceded the 2007 to 2009 global financial crisis. However, there is growing concern that U.S. house prices are again becoming unhinged for fundamentals. This under the title, Real-Time Market Moving Monitoring finds signs of brewing housing bubble. And it's no surprise that when mortgage rates skyrocket 3 to 4% and buyer purchasing power plummets to the tune of 30 to 40%, that we might begin to see some signs of the bubble popping, or at least air getting left out. Let's talk about those signs in this video. First, we need to understand some fundamentals, and that is that real housing prices are now above the upper bound 95% level, which is just a fancy line that the Federal Reserve draws that shows when are housing prices deemed exuberant or too hot. The last time we crossed over this line was right here in a period of time that actually lasted quite a bit, from about the beginning of 2000 to the 2008 market crash. Being above that line, though, is a dangerous sign of a potential housing market bubble. And folks, look at where we sit right here. And this chart only goes through the end of 2021. And home prices have only accelerated in the first 3 months of the year. And that's because those closing on homes in the first 3 months of the year were still able to lock in substantially lower rates than buyers today. If we hop on over to view the price to rent ratio, we also see a substantial decoupling of prices to rents. And so what we have is anytime right here, this blue line and the green line again go above this fancy red dotted line that the Fed has drawn, we get exuberance again based on how far prices have disconnected from rents. You can understand that clearly via the lines on the bottom. And you could see that here as they show you how rents are moving versus how home prices are moving. Okay, so bottom just says if we're above the red, bad. Here you go. We are above the red. And you could see the difference here between rents and home prices. Blue being home prices, that deviation, right? And the same thing we're seeing at housing prices to incomes, but not quite over that red line yet. But that might be because this is based on incomes that have been inflated by stimulus. So where does that leave us now? Well, folks, now it leaves us with housing inventory, that is the percent change of housing inventory, finally skyrocketing. The annual change of active listings is finally blowing up. And people say, oh, well, home prices can't go down because there's no inventory. Well, folks, look at this chart. The only time you've actually seen since 2016 inventory levels move even in the positive direction compared to the prior year was briefly here in 2019. Now, we're seeing a positive move in available properties on the market. This jump in inventory is unsurprisingly leading to a substantial amount of price reductions in areas throughout the country, whether it's Austin, Texas, price drops in all metro areas, whether it's price drops in Seattle, Washington, or Los Angeles, the black line representing an increase in the amount of active listings with price drops. And we're seeing this explode everywhere, especially in markets like Boise, where we're starting to see 10 to 20% of homes with active price reductions. So, folks who say, oh, there's a shortage of homes, just wait. The more we see price reductions, the more houses can potentially, hopefully sell, but can potentially also stagnate on the market at the same time as we're seeing active listings increase. Now, the stock market sees the writing on the wall. This is the MSCI World Real Estate Index, and you can see it's not yet fallen below its 10-year average, but we've come down a substantial amount, about 30% on real estate stocks, because that's the belief of the stock market that real estate is going to suffer impairments of valuations, which would lower the balance sheet at real estate companies like REITs. Basically, price going to go down of houses, so we may as well pre-price the stock lower. That's the thesis. And again, it makes sense when you see interest rates skyrocket the way they have. Now, fortunately, and this is good news for the housing market here briefly recently, is we've seen the 10-year Treasury yield come down off of its highs of about 3.5% to about 3%. This helps keep housing interest rates for mortgages somewhere around 5.5%. When we get to that 3.5% 10-year, we start seeing rates closer to 6.25% to 6.5%. And that's substantially more painful. Another 10 to 20% of purchasing power for buyers evaporating at those higher rates. And so it's no surprise that when we look at a home builder report, the second largest home builder in the country, Lennar, we see that orders and traffic, sales incentives, and cancellations have all worsened in the month of June with Lennar, again, the nation's second largest home builder. They have three categories of markets experiencing suffering. Category 1 markets on screen here have found purchasing power flattening and the pace of sales flattening. Areas like San Diego, Orange County, Phoenix, San Antonio, Houston, and Florida. Category 2 markets are seeing more aggressive price reductions like Salt Lake and Reno and the Bay Area. And Category 3 markets are seeing a more significant market softening and correction. And folks, we have seen this deterioration get worse just since the beginning of June. But folks, are we actually starting to see home prices start declining? Well, that's what we're going to talk about right after I mention this message from our sponsor and, of course, the expiring coupon code linked down below for the courses on building your wealth with real estate investing. Check them out, link below. Sponsor of today's video is Tendies, and come on, everybody wants Tendies. I've been talking a lot about the volatility in the market right now. Institutional money is lining up to put cash to work, and folks, there are companies who are charging you an arm and a leg, like StockX, charging you $40 to $350 per month for access to filtered options flow. But folks, Tendies, link down below, shows you whale purchases, volatility signals in real time for free. Take a look on screen and how easy this is, folks. I talked about Revlon yesterday, so let's see what's going on in the app. You can see charts, you can drop right in, options flow, data, and even what people are saying about the stock all across Reddit. We get memes, we get trades, we get charts, we get order flow all in one app. Now, look, okay, you gotta be careful, okay? And this is why you want as much leading data as you can, because Revlon was another meme movement, but we're seeing meme movements last shorter and shorter. GME meme movement was very, very long lasting. AMC, the ape movement, very long lasting. But what's happening now is we're getting these meme movements on things like Revlon that'll last maybe a week, sometimes even shorter, and so you need the data at your fingertips to make sure you're not getting ripped off. Plus, Tendies integrates with your brokerage platform as well, so you can monitor performance. Now, make sure you click the link in the description to download the Tendies app. It's a great app that is giving away options flow data for free. Check it out. Download Tendies, use the link down below, free options flow algorithm. So what makes us think that the housing bubble has actually started to burst? Well, take a look at this. This is a report that indicates the average momentum of home price appreciation has not just flattened, it's actually the red line. It has started to decline. This is starting to show that in markets throughout the United States, and 37% of markets in the United States, we're actually starting to see home price decreases. And this is a leading indicator. In fact, and this particular data from housingalerts.com, which is a blog who collects this quarter-over-quarter data to try to give us some leading indicators, which are so hard. It's so hard to get leading data for real estate. They list the following counties and cities as showing declines. You can see the declines on the right there, and you can pause the video at any point here, but we can start seeing quarter-over-quarter declines of 0.2%, 0.3%. And if you go through this list, you can see it continue. 0.6%, 0.7%, 0.8%, 1%, 1.4%, going up to 2%, 3% declines in Charleston, West Virginia, and you've got Iowa City here, 3.1% declines. And these are in quarters. If you multiply the quarter by 4 to annualize these declines, if this pace of decline continues, a decline of 3.1% in a quarter could represent a decline of 12.4% in Iowa City, just as an example. And this assumes that we're not going to see an acceleration of price declines. So we're already starting to see quarter-over-quarter price declines. And this makes sense because we saw housing inventory go up. We saw the price drops on active listings. We have more listings stagnating and fewer pending sales. And what comes after that? Price drops. Now, let's go away from a blog's leading indicators and look at what Morgan Stanley and Barclays tell us, or Credit Suisse. Affordability fallen, and this dampens housing starts. You can see housing affordability plummeting and the start of an inflection point in housing starts right over here. Take a look at the next one. We have new and pending home sales. Both have substantially slowed. Gray are pending home sales, and the black line are new home sales. Both of these can be useful as leading indicators, as it takes us until closing to know the price of these, but we know that the volume of them is starting to decline. And so that's why we have to really pay attention to when these houses actually start closing, what kind of declines are we going to see? And then, of course, this is another chart from Morgan Stanley on existing homes available for sale in gray and new homes available for sale in black. And you see an inflection point up that's a little more still traditional on existing, but a substantial explosion in new homes for sale. And it'll just be a matter of time until we see that same movement on existing home sales, as price drops and a lack of sales lead to stagnating inventory and more people listing homes for sale. Now, there's also the risk that institutional buyers potentially slow their purchasing of properties, taking less inventory off of the market. This so far has been corporate buyers as a percentage of the purchasing market, somewhere around 2 to 2.5% for either institutional or iBuyers. And if this flattens or inflects to the downside, we'll have less institutional investors. What about non-corporate buyers? Well, the individual investor is still buying. But what happens when this inflects down and we start getting new data from individual investors no longer buying because they're waiting for potentially better rates? After all, Jerome Powell told us, if you're a home buyer right now, it might make sense to wait for a reset when rates come back down and things become more affordable. Folks, the data is speaking volumes. The real estate market is slowing down, and it's time to get ready to be a buyer. Increase your income, increase your side hustles, increase your savings, and reduce your spending. Get your debt to income down if you have debt, and start talking to a lender today about what you could do to make sure you can qualify for a rental property by the end of the year, or a home for you to move into. Maybe it's a duplex, maybe you want to house hack it. And if you're unfamiliar with real estate and you really want to make sure that you're an expert when it comes time to buy, check out the programs on Building Your Wealth, linked down below, that walk you through these step by step, and use the coupon code in the description. Thanks so much, and good luck.